Welcome to Adulting Startup. You're buying your own toilet paper, you're cleaning out your own garbage. You are an adult. Good job. Well, you have the right to have debt. Are you excited? Debt is really an interesting thing to understand because you can have debt for a consumable, which means you're taking debt, you're borrowing from somebody, you're going to have to pay interest on that for something that goes away. You can have debt for something that's a depreciating asset. That means the value of that item is going down, often a car. You've borrowed money and the car is no longer worth what you paid for it. Careful how much you borrow with that. And you can borrow money for an appreciating asset. The most commonly known, again, would be a house. We assume that that house is going to increase in value. So they allow you to borrow more money against that, usually at a better rate. That's kind of how debt works. The important things to remember are that you consider, I'm going to have to pay this back. Over how long and at what interest rate? Some interest rates change. They're called variable rates, and they're based on what the government says debt rate should be, plus or minus a few percentages. Or a fixed rate, which means you have bartered and negotiated those terms when you set up the contract to borrow the money. Credit cards, that is a fixed rate. In your contract, it tells you what the interest rate is. When you purchase a car, a lien holder, usually that's at a fixed rate. When you purchase the car, you arrange to borrow the money, there is a set rate in your contract telling you the interest rate that you're going to be paying, the number of payments, and over how long. The important thing, again, is to figure out, number one, the total cost of borrowing. Number two, how much your payments are. Three, for how long. And once you've established your debt, do you want to insure it? If you're having a shorter borrowing time, so something that you can pay off fairly quickly, hopefully that would be your credit card debt. Hopefully you're paying that off every month so you're not accumulating a lot of interest. Maybe you don't need to insure that debt. You can probably pay it off with either the money you're making or perhaps you have money in savings. That's a good use of credit card debt. Again, probably don't need to insure it. If you've purchased money to buy a car, if you plan on paying that car back within 3 or 4 or 5 years, and the amount of your monthly installments is easily within your income level and your cash flow, again, perhaps you don't need to insure that debt. If you're purchasing a house and getting a mortgage, you're probably paying that off over about 20, 25 years. That's a lot of time for something to go wrong. It's also probably a greater value. It also probably has a bigger impact on your life if you miss an installment. So to purchase insurance that pays your mortgage if you're unemployed or go on disability or have something happen to your health makes a lot of sense. And to just budget the cost of that insurance into your monthly payments also makes a lot of sense. To purchase that insurance, you can also purchase insurance for your debt through the debt provider often or through a private insurance company. I recommend you compare the two. Often you're going to find that through the private company, you get a better rate, more flexibility, and more security in your insurance. When we compare mortgage insurance through the mortgage lender, as opposed to a personal life insurance policy, personal life insurance policy number one underwrites at the time of the application. So you know that if they say they're insuring you for death, they're going to pay out if you die. Number two, it's a static amount. The amount you're insured for doesn't go down as the amount you owe goes down. So the bang for your buck, for your premium, for your payout, stays pretty good. Number three, it's flexible. So what if you don't need it necessarily for your mortgage, but you still need that life insurance for something else? Maybe another debt you have. You can use it for that. Why? You own it. It's yours. You can do with it what you want. That's often an example of the sort of debt insurance that we would see early adults using. Not typically a lot of insurance for early adults, probably just, again, more likely ensuring that you can make your payments on something that's important to you if you lose your job or if you get sick and can't show up at work, because you're just getting started. You probably don't have a huge emergency fund yet. and it's really important to you that you're able to make those payments, that would be the most common use in early adulting for debt insurance.